Hey everyone, Bill Lethman here with Money Evolution. In today's video, I'm going to be talking about some of the biggest Roth conversion mistakes that I see people making all the time. I think about 7 or 8 of them on here, and I'm going to kind of just go through this list relatively quickly. So the first one on my list is not understanding the December 31st deadline for doing a Roth conversion. I don't see this too often anymore, but every once in a while, I see people that are thinking that they have until April 15th or tax filing deadline to do a Roth conversion for the prior year. So again, it is something you have to do during the calendar year. You've got January 1st to December 31st to do those Roth conversions. If you're doing it late in the year, as you kind of understand your income a little bit, make sure you're giving yourself enough time to allow for the processing of that Roth conversion, because sometimes that could take a day or two. And with holidays, you don't want to be waiting till exactly the last minute. Number two is not understanding the 5-year rule. Now, so for taking out qualified distributions from a Roth IRA, one of the caveats to that is you had to have the Roth IRA established for at least 5 years. So you could have put $10 into a Roth IRA account 5 years or longer ago, and then contributed more money to it later. And the clock started ticking when you made that first 5-year contribution. But on a Roth conversion, every time you make a Roth conversion, that's going to start a new 5-year window. And that's very important for you to understand as you're going into retirement. I've actually seen it in a couple of our financial planning clients where people have converted a whole bunch of money over to a Roth IRA account, and they end up in a situation in retirement where they almost don't even have any money that they could take out because all of it's tied up with that 5-year rule. So every Roth conversion starts a new 5-year window in order for that to be a qualified withdrawal. So very important to understand that. Number three is how you invest a Roth IRA account and why I think you should invest that money differently than your traditional IRA account. So we've talked a lot in some other videos about the 3 tax buckets. You've got your non-retirement account assets, things like brokerage accounts and things like that. You have your traditional retirement account, IRA or 401k, but money that is going to be taxed when you pull that money out. And you have your Roth bucket as well. So because the Roth bucket enjoys the best long-term tax advantages, you want to have that money, generally speaking, as your more aggressive investments with the longest time horizon. So you could take advantage of those greater returns, hopefully, if you're doing well with the market. And then your more conservative investments might be in those traditional retirement accounts. So doesn't mean you change the asset allocation of your whole portfolio, but you definitely divide that up differently for those different tax buckets, and you're going to want to have that Roth account invested generally a little bit more aggressive. Number 4 is not fully understanding your tax bracket. So we've talked about this a lot in other videos, that the main objective of a Roth conversion is you're going to convert money from a traditional IRA account to a Roth if you think your tax bracket in the future is going to be higher than it is when you do the conversion. And if it is, then it generally makes sense for you to do that conversion, pay the taxes at the lower tax rate. But in order to really put that together, you need to have a plan. You need to have an understanding of what those tax rates are today versus what they are in the future. Of course, we use some very sophisticated software to do that. It's part of our Wealth Vision financial plan. If you want to learn more about that, you can check out some of the links down below on that, where we help people map that out so you can understand what your tax bracket is today, what is that going to be in the future, and then we can really help dial that in of exactly how much of a Roth conversion you might be thinking about, what makes sense. But understanding those tax brackets, and that's a very big one. Number 5 is going to be not paying the taxes in the quarter that you do the conversion. I just did a whole video on this, and I think the video title was How to Pay Taxes on Your Roth Conversion. But if you're doing a Roth conversion in the first quarter of the year, you can't wait until tax filing of the following year to make those estimated tax payments or to pay your tax on that, because you're going to probably end up with a underpayment penalty and maybe some interest in there as well, because you didn't pay enough of that money soon enough to the IRS. So you're going to want to make sure that you're paying those taxes along the way, as you're doing those Roth conversions, generally in that quarter or when that quarterly deadline for estimated tax filing is there. Number 6 is the pro rata rule. Now, this gets a little bit technical. I've definitely talked about this in other videos, especially as we've talked about maybe doing the backdoor Roth IRA conversion strategy. But we see people, surprisingly to me, a lot of times with money that has commingled money that's already been taxed, after-tax money, along with earnings on that. And so understand that. Let's say you have a $50,000 IRA account, and let's say that half of it is contributions that you made on an after-tax basis, and half of it is earnings on that. So if that was your only IRA account, you would be able to convert that $50,000 over, and half of it would be taxable as that conversion, and half of it would be non-taxable because it's money that you've already paid taxes on that. But if you were to, let's say, have another IRA account, let's say you had a second IRA account that had a $100,000 balance in it, now, even though they may be two completely separate accounts, that $50,000 account that has 50-50 after tax and pre-tax, basically, you have to consider all of that money together. So you actually have a $150,000 IRA account according to the IRS, even though it may be in two accounts, it may be in 3 or 4 accounts, but all that money has to be kind of considered together. And that pro rata rule is something that kind of messes people up sometimes because they think because they have that money sectioned off that they can isolate that and just do the conversion on those assets. But that's a big one there. Number 7 is going to be state taxes. So if you're thinking about or you're planning to move to a different state that maybe has a lower tax bracket than what you're in right now, maybe has no tax, state tax, you're going to want to take that into consideration as you're figuring out, is my tax rate today higher or lower than what it's going to be in the future? So if you're moving to a zero tax or a lower tax state, it may make sense for you to wait to do that conversion, even though your federal tax bracket may be a little bit higher. So you need to consider that as well. And then finally, the last thing I want to talk about as a mistake that I think people make with Roth conversions is thinking that they can't do the Roth conversion because they don't have the money to pay the taxes on the conversion. And of course, you want to pay the taxes on the conversion, but let me explain a little bit. So, we oftentimes talk about those 3 buckets there. The non-retirement account assets are kind of the ideal spot that we want to pay the taxes for those conversions out of that bucket. But if you don't have any money in that, or enough money, I should say, in the non-retirement account bucket, can you still do a Roth conversion? And you can. I talk about this as well in that video of how to pay the taxes on the Roth conversion. But you can actually take an extra withdrawal from your IRA account as you're doing that conversion, and that withdrawal is what you're going to use to pay the taxes. Now, one thing I do want to point out is if you're not 59 and a half, even though you're doing the conversion, that withdrawal is going to be subject to a 10% penalty. So that is something that if you're under 59 and a half may be an issue there. But don't think that just because you don't have the money set aside in that non-retirement account to pay the taxes that you shouldn't do it or that you can't do it. You can do it. You just have to take some of the taxes out of the IRA account to cover the amount that would be due for that conversion. And again, that's one of those things that if you want a little bit of help, be sure to seek out some professional guidance for that. That's something we help clients work out all the time in a course of our comprehensive financial planning. So anyway, there it is. I think it was 8 points, maybe 9 points there. We went through it relatively quickly. Again, we talk a lot about Roth conversions here on the channel. So if you haven't already subscribed to our YouTube channel here, be sure to do that. Hit the like button. Like to get the word out there. And with that, maybe check out some of the links below in the description. We've got our comprehensive financial plan called Wealth Vision, our retirement planning course called the Retirement Time Machine. And with that, I look forward to seeing you back in one of our next videos. Thanks.